IPO stands for Initial Public Offering. So it represents an event where shares of a company are offered to the public for the very first time, and they start trading on an exchange. So an IPO may only represent a small percentage of the total outstanding shares, and the rest can be retained by original investors, just like I mentioned in the previous example. Now, the money paid for the initial offering goes to the company that issued those shares as working capital. After the IPO happens, the shares trade on the secondary market, and you're essentially just paying money to someone else who is selling their shares versus to the issuing company. So IPOs are typically very, very volatile in their first month of trading. I've been in the business for over 20 years, and there's always so much excitement every time an IPO comes out. But what happens is we typically watch the shares spike and then they tank. So what happens in the long term? Is it a good idea to buy the IPOs? Well, there was a study done by the University of Florida that shows that a buy and hold strategy for IPOs resulted in inferior returns compared to buying and holding similar existing companies by 2.4% per year. So, I was reading through this study this morning, and it really confirmed what my experience has told me, that it's really excitement that drives these stock prices up when an IPO comes around, and excitement motivated by greed for the most part. So people, think that they're going to be getting in on the next Microsoft or the next Amazon or the next Google, and very well that could be the case. But more times than not, there's a lot of these companies that just end up going out of business altogether, or as you see, that they'll spike up, and they'll still be. I was hearing just today about another IPO that was very very hotly anticipated, very much interest in it, and it came public, and it's trading a month later now below the initial offering price. So a company's initial value is estimated by the company and the investment firm that brings it public, and that's where we get the initial offering price. Once it starts trading, though, the market is going to determine its value. So there's the market, the experts are going to look at earnings. They're going to look at forward guidance that the company gives. They're going to look at profitability. They're going to look at valuation. How much money are you willing to pay per share of a stock for the earnings that it generates currently? And, making some assumptions about what it's going to do in the future. So it's very common also for an IPO to have a lockup period. And that is when a company goes public, the major shareholders are prohibited from selling their shares. That typically lasts anywhere from 90 to 180 days after the IPO. So if a major shareholder and founder of the company is now ready to cut back on some of their holdings to cash in on the hard work that they've done to make that company to successful to the point that it is, and to bring it to the IPO, then, that can really put downward pressure on the sales price. Then greed also attracts lots of speculators and traders who make bets on what the stock will do, bringing out short sellers and, people who can really move the stock price one way or another. So words of wisdom for that is that, investment decisions should be made unemotionally and based on the facts and the fundamentals of a company. And you should really fight the temptation to fear of missing out and take a level-headed approach.